in contrast to what we've been saying over the last 3 or 4 years, that interest rates will go up, interest rates have gone up. Now actually what has happened is interest rates have gone up more for on government bonds and for some of the business community than they have for the farm sector. Interest rates on operating loans haven't gone very much. Land interest rates went up a little bit in the summer and early fall, pardon me, in the summer of this year, but then they've actually come back a little bit now, just like interest rates in the overall market have come back a little bit now, come down a little bit now. And that's a reflection, we think, of the slowness in the economic growth and the uncertainty about the economic growth, more so in Europe and the rest of the world than in here, and in China and in Russia, etc. So this recovery that we're trying to sustain is difficult to sustain, and even though we seem to be showing some economic growth, the rest of the world is not, and that then makes the capital markets pretty nervous. When interest rates go up faster and more than they have depends almost exclusively on Federal Reserve policy. The Fed has said that they will probably facilitate interest rates going up mid-2015. We expect that that is going to happen. So we do see interest rates up on some of the term debts, up a little bit 2015, towards the end of 2015. Shorter term interest rates have the potential to go up more than longer term rates do. We've got a pretty steep yield curve. We think that that short term rate, because that's where the Fed has the potential to play the most and have the most impact, they will probably go up a little bit more in 2015. Maybe one should be position themselves for 150 plus or minus basis point, or 1.5% percent increase in interest rates. We don't see interest rates running away in the short term, obviously, nor actually in the long term. We think that we're not in, again, one of those environments where interest rates are going to skyrocket through the roof. What would happen, or what would make that prediction not true, would be if for some reason inflation were to increase dramatically here in the short run. Inflation is actually running lower than the Fed would like it at, they'd like it at 2%, it's running closer to 1%. Nobody sees runaway inflation at this point. If that were to happen for some reason, we could see interest rates rising faster. The other side of these interest rates is that we just don't see a strong economic growth. And until we get more rapid, stronger economic growth in the world, incenting capital expenditures and new investments by businesses worldwide, we don't have the same kind of demand on the capital markets which we which we currently have. So we've got to get a stronger economy, and we've got to get more inflation pressure before we see those interest rates move up very sharply.